It is my absolute pleasure and honor to introduce our special guest today, John Murphy. Tom and I consistently tell our viewers, John, that how much we've learned from you, really the basics from you, as well as just some of those special nuances to technical analysis. You've been a great mentor to us both. And again, great to have you here. It does look like an especially interesting market day.
Erin, first of all, thank you for that very nice introduction. Yes, we picked a good day to do this today. We all know the market is suffering some pain. But the point I want to try to make is that, I always look at fundamentals and technicals. I think you really have to look at the two of them together. And I think we all know why the market's down. We know one of the main reasons the market's down this week is because of the trade situation. But I want to make the case that another reason for the sell-off has to do with technicals. In other words, the fact that the market was ready for a pullback, and that's really the whole point of this message. I'm just going to read the headline. This is the headline that was written yesterday. World stock indexes are testing overhead resistance and looking overextended. That may explain their bad reaction to trade tensions. So it's really a combination of some bad economic news at a time when the markets were vulnerable. And then just the world stocks have to clear resistance levels to resume their uptrend. Well, that's kind of obvious. But that first paragraph there, trade tensions rattle overextended global markets. We all know it all started with a tweet last Sunday night. And of course, Monday and Tuesday were especially negative days. But again, it's the combination of the two. And I want to say on balance, the global markets still look positive. We're going to look at 4 or 5 of the major markets around the world, and you're going to see essentially the same thing in all of them, that they're all up against some kind of a resistance barrier while they're in a very overbought condition. They all have one thing in common. All of those markets are up against barriers and overbought. Now let's start with the U.S., which obviously is the most important market, I think. We're going to use the same chart format for all of them. This is a weekly chart. Now this is through let's say Wednesday, okay? And the whole point of this chart is just simply to give us a longer-term perspective. The market's had a spectacular start to this year, but we are right up against the highs of last September. We went a little bit above it last week, but not meaningfully. And you can see that red bar. That is through, let's say through maybe Wednesday morning. You can see the sell-off. So I think it's safe to say anytime the market has this kind of a rally, we're up like 25% in a short period of time. We're up against an old high. Every chart reader knows that becomes if the market's going to stall or pull back, that's a normal place for it to happen. And if you go a little bit further up on the chart there, you can also see that the 9-week RSI, overbought territory over 70. That's the first time we've been overbought since the fourth quarter of last year, starting to weaken a little bit. Also, the histogram bars, MACD, those green bars. I still use MAC, but I'm starting to switch over a little bit more to PPO, the PPO indicator, but I still use the histogram bars. They're still positive, which means we're above the zero line. But notice they're starting to weaken a little bit. That simply means that the uptrend is starting to weaken a little bit. So overbought market, a little loss of upside momentum, and we're up against resistance. This chart shows that the S&P was testing its blue line. That's the 10-week or 50-day. We've actually broken below that. So it seems reasonable to assume that we will go down and test that red line, which is the 40-week or the 200-day moving average. So the fact that the market was in a vulnerable position is the reason why I think we're getting this negative reaction. But let's move down to the next chart, which is Canada. I'm going to stick with North America. The chart is very, very similar, remarkably similar. In fact, you can see this is the Toronto index, and it's right up against, again, the high that I think that was the September high. Same thing, pulling back a little bit. The last time I looked, it was also breaking below that blue line today. So the 10-week or the 50-day moving average is being broken. And again, same thing, the market was overbought, starting to weaken a little bit. So when we look at both the US and Canada, we had a situation, markets up against major resistance, extremely overbought. And at that particular point, we get some bad news starting to pull back. Now let's leave North America and let's move to some foreign markets. Now, one of the things you'll notice on all these foreign markets, they're not nearly as strong as the US. They have been rallying through the first quarter of the year, or the first 4 months of this year. They were all rallying in sync with us, but much weaker than us. But none of them had reached the old highs. But even so, they have reached resistance barriers. Now we're going to start with the DAX because the DAX is really the key market in Europe, or the Eurozone at least. It's the biggest market in Europe. It's the most influential market. And by the way, the German market is very closely linked to the Chinese market because German economy is very export oriented, and a big chunk of those exports go to China. But anyway, the point of this chart, these are weekly bars. If we just look at the bars themselves, you can see that the DAX has had a nice rally since the beginning of the year. But just simple chart analysis, I just simply drew a line along the highs of last year. And you can see that the DAX went above its target last week, but we're back below it. So I think it's safe to say that it looks like the DAX right now is failing a test of that falling trend line. The DAX is down over 1% again today. And bear in mind, that is the biggest economy in Europe and very closely linked to the Chinese market. So it all makes some sense here. But the point simply to make here, it's the same thing, overbought. So you look at the indicators, we're seeing the same thing in all the markets. The point simply that the DAX is up against resistance. Now let's keep going. We'll go to Asia. And first of all, look at the RSI right on the top. We're going to look at the Nikkei index. And you can see that the RSI going back, whatever that is, 2 years, we're right up against. We didn't quite reach overbought territory, but right up against a trend line. So that's usually a sign that the market is a little overextended. But if we look at the price bars themselves, again, remember, this is the Nikkei, the Japanese stock market. You can see it had a big drop, during the fourth quarter of last year, along with everything else. We've had a very strong rally during the first quarter, the first 4 months of the year. But notice those last two bars there. Now, this chart is through Tuesday, I believe it was. No, I'm sorry, through Wednesday. So you can see those last two bars there. Now, why we're up against resistance? What I did here is you see those horizontal lines there. Those are Fibonacci retracement levels. For those of you who don't know what they are, it has something to do with Elliott wave theory. But normally when markets are retracing a portion of a previous trend, for example, in this case, we're retracing the downtrend, there are certain levels that become very significant. 61.8% normally is a significant barrier. Whenever a market retraces 62% of a previous trend, that often is a point where the market will stall or start to retrace. So it's a significant resistance level, and the Japanese market reached that over the last week or two. I don't know if you can even see that last bar there, but it gapped down. There's a little tick there. The market actually gapped down. The reason the Nikkei gapped down so much is because on Tuesday, when most of the other markets sold off, the Japanese market was closed for a holiday. So I won't say it caught up, it caught down actually. So it gapped lower, and the Japanese market is down sharply again today. So the point of this chart is just simply to show that even in Japan, although we're nowhere near the old highs, even the Japanese market had reached a resistance level and is starting to weaken. And then the last market we're going to look at is the Chinese market, the Shanghai market, which is probably the most important one at the moment. And you can see sort of this chart isn't as convincing, but I did the best I could with it. This is the Shanghai market. And you can see how weak the Shanghai market was. These are weekly bars, by the way. Since the beginning of 2000, in fact, last year, the Shanghai market was the weakest market in the world, okay? And kind of weighed on everything else. And I think the weakness there eventually led to the big sell-off in U.S. stocks at the end of last year. Now, since the beginning of this year, the Shanghai market was the strongest market in the world and actually led the global rally. It rose faster than the U.S. It was by far the strongest market in the world. We have to assume that a lot of that had to do with the fact that there were, let's say, more optimistic feelings that the trade situation was going to be solved. They kept telling us that everything was going to be solved. They were close to a resolution, and anyway, it was the strongest market in the world. It went a little bit above the 62-point line, but I measured it today. The actual recovery was 2/3, which is another technical. I'm not actually making this up. This is actually true. 2/3. It actually rallied about 2/3, which is another point. But the bottom line is it has weakened since then. You can see that last bar. Again, this chart is through Wednesday. The Shanghai market gapped down very badly. In fact, I believe it is the weakest market in the world this week. Shanghai market. I think on Tuesday it was down 5%. I think it's now down another 2% today. Gapped lower. So you can see, though, it's clearly leading the world lower, which shows how important the Chinese market is. But the really important message that I want to make in all of these is that all of these markets were up against resistance barriers. They were all due for a pullback, and I think we're getting it. I finally want to wind up with just two indexes, two world indexes, which I think are worth looking at. The first one is the world indexes are also testing overhead resistance barriers. The first one is the MSCI All Country World Index iShares. Now, this is we use this as an index for the global stock market. Okay, and you can see that overbought, MACD lines weakening. So we see this everywhere. But if you look at the chart itself, you can see that we had a tremendous rally this year, right up against the highs of last September, sort of what we're seeing in the U.S., and starting to back off this week. In fact, I looked this morning, that blue line there, it's testing the blue line. Again, this chart's 2 days old now. Would actually fell below that line today. Now, the only problem with looking at this particular index, yes, it does give us an index, a picture of the world, but it's a little misleading because the U.S. accounts for almost half of that. You know, it has a very heavy weighting, and we really dominate, and we have been the strongest market in the world. So this index, even though a lot of us look at it, it really doesn't give us a true measure of what the world is doing. To do that, we have to go to our final chart, which is the one I really want to talk about, which is the MSCI All Country World Index ex-US. This is what the rest of the world looks like without the US, okay? And it's an index that includes emerging markets, it includes foreign developed markets, it includes Canada, it includes everything outside of the US. And it paints a very different picture than the chart you just saw. First of all, you'll notice that we'll just focus on the price bars, I think, for this one. You can see that this index actually peaked in the beginning of 2018. You may recall our market last September, our market also corrected at the beginning of last year. But you may recall last August, September, our market was hitting a record high. And I remember writing articles at the time that this made no sense. How could our market be hitting record highs when the rest of the world was actually falling? It didn't make any sense. And I think that contributed to the huge pullback in our market in the fourth quarter of last year. But anyway, this index bottomed right at the end of last year along with us, and you'll see that it's rallied very nicely. So our market always does better when foreign markets are rallying with us. It is true that our market has done better than the other markets, with the exception of China. But the fact that they're rising was good for us. And you'll notice that blue line, black line that I have drawn in there, right around the 48 level, that is the 62%. We're coming back to that again. The 62% retracement level. Normally when a market rallies, when it gets to the 62% point, especially if it gets there too fast, it's usually vulnerable. And also you'll notice that was the peak that was hit last September. So even the foreign stocks hit resistance, got overbought, and they're due for a pullback. And of course, this index is down fairly sharply again today. It looks to me like with all these blue lines being broken, the 10-week moving average, it looks like we may have to sweat out a retest of the red lines, which is the really that's really the test of the major trend, the 40-week moving average, the 200-day moving average, with a lot of 50-day moving averages being broken all over the world. I think there's a very strong chance that we will retest that red line, and that will be a bigger test. But the whole point here is just a kind of the confluence of technical and fundamental factors. If this news about this trade situation had come out a month or two ago, I'm not sure it would have made that much of a difference, because the markets were rallying, we were getting good economic news, the Fed was on hold. But the fact that all these markets together have rallied up into major overhead resistance, they're extremely overbought. Some of the indicators were already beginning to lose momentum. Simply meant to be, the market was due for a pullback anyway. And then when we got the trade news, we're getting a very, very negative reaction. So it's sort of a confluence of technical and fundamental factors. I have to believe that if this trade situation is resolved at some point, these markets will rebound. But I do think before that happens, we will see more to the. I still believe this is a correction in an ongoing uptrend, but I think we're gonna have to retrace some of these gains during the first part of this year before the markets are able to stabilize again. And with that, Tom and Erin, I think I'll turn it back to you and see where you want to go from here.
All right, I have a question for you, John. And I think from these charts that you've shown, first of all, great explanation. I agree with you. I think that many of these overhead resistance areas provided technical reasons for selling, and then we get some fundamental news to kind of piggyback on, and I think that's why we're seeing a lot of selling. I want to go back to the Chinese market, though, for a minute, and the Shanghai. And you can see that in 2018, and you and I were talking about this before the show, I think it was clear that markets around the globe were saying that the U.S. was going to win out on this trade war. The steepness of this drop in China versus what we saw in the U.S., and I subscribe to the buy on rumor, sell on news, or sell on rumor, buy on news kind of approach. And I think that's what happened here with China. I just want to get your thoughts on this. When everyone was fearful and we were talking about the trade war, China got hit much harder than the U.S. And then when things just kind of subsided and we started strengthening and everyone started thinking, okay, and even President Trump was tweeting off and on about, we're getting closer and closer to a trade deal. The news seemed a lot more positive. And once we got to that point, that's when we saw China really beginning to outperform. Now, all of a sudden, there's a bunch of uncertainty again, and there's a war of words going back and forth between the two countries. And we're seeing this big drop. Once again, things a lot worse in China than they are here in the U.S. So my question to you is that, let's say we get this deal, and I don't know if it's going to be this week, next week, a month from now, or whatever, but do you believe that China has already been priced, a lot of this trade deal has already been priced in to China, and that once we do get a deal, do you think China rebounds and outperforms the U.S.?
I sure hope so. I don't know if they'll outperform us, but what's interesting about that chart, Tom, first of all, just applying simple chart analysis, you see that little double bottom there between October and December, and then it rose above its 40-week moving average. But it's clearly the fact that the rebound. This obviously has to be tied to trade news. The fact that the Chinese market did so well during the first 4 months of this year, I think really took a tremendous weight off the rest of the world. And as I mentioned, it has been the strongest market so far this year up until this week. Now it's become the weakest market again. So clearly what happens in China affects what happens here. But also, I think what you're also asking is that the chart clearly indicates that China has a lot more to lose than we do. I mean, as I mentioned, we were hitting record highs during the fourth quarter of last year when China was plunging. So I hope that the Chinese negotiators know how to read charts, and I hope they're looking at some of these charts, because when they look at on Tuesday, the Shanghai market plunged 5%. Now, we were down 1% also. They're down 5%. Clearly, when the trade news gets bad, China gets hit a lot worse than we do. Clearly, we do suffer, and the rest of Germany suffers, and the rest of the world suffers. But China has the most. The charts seem to suggest that China has the most to lose from this. And I think from just listening to most experts, the feeling seems to be that it would be almost suicidal for both countries to have a serious prolonged trade. It would be suicidal for both countries. The fact that it wouldn't be good for us, even though we wouldn't do as badly as China, it wouldn't be good for us. So the general feeling is sooner or later, they're going to have to come to some kind of a resolution, and hopefully that will help. I don't know that that has to happen to stabilize the markets. I think even just a statement that we're going to reopen talks or something like that, and we're optimistic, that might even be enough to stabilize the markets. But clearly, you can trade the U.S. market without looking at what's happening in China and what's happening in these other global markets.
Okay, so I'm going to take it maybe in another direction. Let me move over to, tell you what, I'm going to look at the S&P 500. I want to take a longer term view. I mean, we're going through 2018 and 2019, but let's pull up a longer term monthly chart. I know we've got a lot of folks that are much longer term that listen into the show from time to time. And I know a lot of your analysis, John, is many times focused a little bit more on that longer term. When you look at an S&P 500 chart, and this goes back just the last 15 years, but I can go back and, let's go back 30. My argument, and I'd love to get your take on this, my argument is that we're out of the secular bear market that we suffered through for 10, 12 years here. And when we got that breakout in 2013 to take this double top out, I believe we entered a secular bull market. And so when you see these pullbacks, and at pullback, it almost seems too harsh to just call it a pullback from the fourth quarter of last year. But these, in my view, are more secular. This is a secular bull market, more cyclical bear markets in nature. Would you agree with that? Do you think that the long term remains up here, and that whatever happens in this next couple months is a buying opportunity?
Well, yes, we certainly are in a secular bull market. There's no question. We were in a secular bear market between 2000 and 2008. And we've been in a secular bull market for the last 10 years. The only thing that concerns me is that we are now the longest bull market in history. No bull market in history has ever lasted longer than 10 years. So that kind of worries me a little bit. And as it does turn out, when we had that sharp downturn late last year, and a lot of us were calling it a bear market. But I think you're right. I remember reading you writing about this, that it was a cyclical bear market, which means a shorter term bear market than a longer term secular bull market. But what does concern, Tom, can you just zoom in on this chart just a little bit, like just the last 10 years? What bothers me a little bit is that, I say it is the longest bull market in history. What bothers me a little bit, we are going through a retest of the old high. Yes, the trend is still up. Moving average trends are up. But if the market's going to run into any serious problems, this is where it's going to do it. And by the way, that indicator on the top of the chart, I don't know if you meant for me to talk about this. That is, I believe, the PPO.
Yes.
Yeah, I know you like that indicator. I listened to your workshop earlier today about why you like it so much. But you'll notice that is negative. Every pullback, I wouldn't even pullback, every downturn we've had in the last 10 years, those lines, we had one in 211. Well, first of all, 209, obviously, 211, it turned right back up. 216, it turned right back up. It's still negative.
Yeah.
And I keep looking at that and I say, well, maybe it's just it is a lagging indicator. I understand that. I hope people know what we're looking at there, Tom. But this up there, it's still negative. So the fact that we're testing the old highs and we're still negative, we are the oldest bull market in history. Yes, the trend is still up, but I'm a little cautious here, I'll have to admit.
Yeah, and I also would throw in there too, Aaron, and you can chime in. But I know Decision Point uses the PMO, which is fairly consistent with the PPO. It's not exactly the same, but I know the PMO on a monthly chart is still below that signal line, and still, I think, and I don't want to take the words out of Aaron's mouth, but there she goes. She got the chart up there.
Yep.
But that's a problem on the long-term weekly chart still. Am I correct?
Not only that, Tom, but if you look at that indicator, notice that it is still below its 216 peak.
Yep.
Yes.
So not only is this is very long-term stuff, not only is it negative, but I remember we all pointed out at the end of last year when well, I'll speak for myself, I started turning quite negative. This is one of the things I pointed out, that for the first time in 10 years, this long-term monthly indicator was not only turning negative, but it was giving a major negative divergence. Now, the market has recovered nicely since, but I'm still a little concerned about that. I would feel a lot better if that line turned positive. It hasn't done it yet. So I'm still a little nervous about the fact that this is the longest bull market in history.
Right. And I know I've been very bearish. And some people might see this, we have that little top under the signal line, but guys, we're only about a week into the month. So I'm not really going to put a lot of emphasis on the fact that the monthly PMO turned down, because we have a lot more trading to go, and we could see it turn itself right back around by the end of the month. I'm not so sure we'll see that. But I've been writing a lot about these PMO sell signals on monthly charts. They just don't happen that often. And they usually do give us some warning on some key problems, even if it's more short term, like you can see back here.
Yeah. And looking at that chart, Aaron, I would just say too, if you look back to 88 through 92, the monthly PMO kept dropping, but prices kept going up. I mean, once you've had a big move and you get that PMO or PPO or whatever momentum oscillator you're looking at, once it gets up pretty high, it's hard for that to keep going up. It's not a price chart, it's a momentum chart.
Sure, and it's an oscillator.
Yeah, so I mean, sometimes price action moves up when you're coming back down, and you never really get a big move down. Sometimes you just get that consolidation. And so maybe back to your point a little bit, John, I think a little consolidation here would not be a bad thing to bring that PPO down a little bit. I'm very bullish, and I'm very bullish, not just in the short term, but I think the next 5 to 7 years could be an extremely big move. I see a lot of things taking place very similar to what we had back in the late 90s. And we see what happened back in the late 90s in terms of the S&P 500. We had a big run up to the upside. I love the fact that the S&P 500 is outperforming, and until something else on a longer term basis can begin to outperform the S&P 500, I think this is an area we certainly want to make sure that we have a lot of exposure to.
And Tom, it's interesting. I was noticing, looking at that weekly chart, the market rose 19 weeks in a row since New Year's Eve, Christmas Eve. 19 weeks, not in a row, 19 weeks. 15 of those weeks were up. There were only 4 weeks where the market pulled back, and I think the biggest pullback was 2%. I mean, that's phenomenal. That's just incredible. And I know that a lot of people who were looking to buy back in kept waiting for a dip, and they never got it. I still suspect this is just a little anecdotal, but I think there were a lot of people waiting on the sidelines, hoping and praying for a pullback so they can, and I think money managers as well, some that I know, are waiting for a pullback to put some money into this market. So I agree with you, even though I'm somewhat nervous. The trend is clearly up. I think if we got, maybe we'll retrace a third of this correction, maybe a third. 50% is probably a little too much. But I think if we can get a decent pullback here, work off these overbought conditions, have the market stabilize a little bit, I think the market could be in a healthier technical position.
Yeah, I would agree. All right, I'm gonna change topics here, and I'm going to focus now on the sectors. We talked very briefly about this before the show, but I'm going to go ahead and bring up the 1 week performance. Let me just get an update, make sure that we've got the latest here. But this is the last week, so this encompasses a lot of what we've been seeing to the downside. When you look at this, John, and take a look at what's been leading us to the downside, do you draw any conclusions?
Yes, very definitely. These are all trade related. I'm surprised. Materials, for example, got hit very hard this week. Bear in mind that mainly materials are what's really leading it lower. I even looked today, copper stocks, aluminum, steel, and copper stocks, chemical stocks to a certain extent. But really, if you look at where the weakness was this week, aluminum, steel, and copper, these are economically sensitive groups. Copper is very, very closely tied to China. China is the biggest importer of copper. And I think I pointed out earlier in the week that the price of copper has really started to fall. Copper stocks are in decline. So I think this is very much tied. Oh, there you go. Right on cue. It's almost like we rehearsed this, which we didn't.
I'm listening.
Thank you, Tom. So copper stocks doing quite poorly. So I think that I also noticed today the Australian dollar is very close to a low for the year. It's the hardest hit currency over the last month. It's a little off the subject, but the Australian dollar is very close to the industrial metals, also very close tied to China. So, and then, so we had materials, which you just showed. The other one was, there you go, materials. Then the technology very closely tied to trade with China. Apple, for example. In fact, if you look at the weakest markets in the Dow today, Intel and Apple are two of the weakest. Intel, of course, is semiconductor stock. Semiconductors are very, very closely tied to the trend in China. And of course, Apple also, all the Apple suppliers. So technology stocks are getting hit very hardly as well. Industrial stocks, like, well, Boeing may be going down for other reasons. But yeah, there you go, Tom. You're keeping up with me. Very good.
Fine. I'm trying.
Yeah, you're doing a great job. There you go. Industrials also very closely tied. Boeing, Caterpillar, anything tied to global trade, aerospace, and even some, by the way, in the industrial sector. Bear in mind, the industrial sector also includes transportation stocks and delivery services. Some of the transportation stocks have started to weaken. So these are really technology, industrials, basic materials. These are all stocks tied to global trade. So it isn't a surprise to see that they are leading the market lower. It all ties together. It all makes sense.
So if you were, if you wanted to trade, but you didn't want all this volatility, I mean, obviously the volatility is applying mostly to the areas you just mentioned that are really tied to the trade. Would you try to stay away from areas that maybe that were involved because there's so much uncertainty right now? Would you rather stick? I mean, I was just looking, for instance, in the industrials, and I saw railroads. Of course, railroads, as far as I know, don't ship across the ocean.
No.
More, North American kind of stocks. So would you favor groups like railroads, for instance? That
go back to that with that list you just showed, Tom. It's interesting. Yes, railroads very definitely, because in fact we've shown, I think you have, and I know we've both shown charts of railroad stocks over the last month or two, hitting record highs, and they are very closely tied to the American economy, because you have to ship the goods, whatever it is, the materials and the grains and all that. So the rails certainly look very good, but heavy construction, not heavy construction, I was going to say home construction, stocks tied to home building, for example, have done extremely well. They're more in the consumer discretionary sector, have done extremely well because of falling interest rates. But if you're looking to hide right now in the market, I think you sort of have to stick with some defensive stocks like consumer staples, at least for the time being. If you want to do some rotating over the very short term, I think you have to stick with staples or utilities or something like that. But I personally don't recommend a tremendous amount of rotating for short-term stuff,
Well, this kind of leads into a question that we did have in the room. And the question was, would you hold on to, healthcare and biotech stocks and ETFs at this point, hoping for better times? And of course, my first answer is never trade on hope. So I'd be very interested in your take.
That's a good one. Healthcare stocks are very interesting. They were next to energy. They were the second weakest group of the year. And I believe they're below their 200-day moving average. And every time they start to bounce, they fall back again. The problem, people think of healthcare as being a safe sector. And it is true to a certain extent if you think about pharmaceuticals and things like that. But biotech, in my view, is one of the riskiest parts of the market. And they really got hammered earlier in the week. There you go. Right on cue. Thank you. Erin, did you do that?
No, I have to give Tom credit.
Okay, there you go. So, it is true that healthcare has traditionally been viewed as a defensive group, but right now they don't seem to be operating that way. And I think the main reason has to do with biotech stocks. So healthcare, I wouldn't consider that a defensive group. If I was looking to hide right now for a little bit, I'd probably go with consumer staples and utilities. They're very defensive. And also bond yields are down. As you know, bond yields have been falling the last week or so. And normally when that happens, dividend paying stocks tend to do a little better. And you might also include REITs in that. So those are the places I would probably hide if I were looking to hide. You can see right now, energy is just, I don't know what to do with that. Healthcare, communications. I would say consumer staples, utilities, and maybe REITs. If you were looking to just hide, just for the next few weeks or the next few months until we ride this thing out, that's probably where I'd be looking right now.
Okay. Well, you mentioned energy, and so I wanted to pull up a longer-term chart here. I'm going to go back and let's do a monthly chart that goes back the last 20 years on the U.S. dollar. And then down below, what I'm going to do is I'm going to bring up the relative strength of energy. This is a chart that I show here a lot on Market Watchers Live. And then also, and by the way, I always try to credit you because all of your intermarket relationships, it has definitely changed the way I look at the market over the years. So I give you full credit for this. But let's take a look at, pull this up first. And let me make this a little bit bigger down here so you can get a better view of it. Yeah, anytime I use the relative strength and comparing two different symbols, I like to use the line chart as opposed to a candlestick chart. I just think it comes out a lot better. And just wanted to get your thoughts on this because the question comes up a lot. Energy and materials have been lagging for quite a while. And when I look at this chart, first of all, the last bull market that we had, 2003 to 2007, you can see the dollar was declining and energy and materials led the S&P 500. But I believe we're in a different environment now with this bull market being accompanied by a rising dollar. And I remember listening back, I don't know, in 2011 and 12, everybody was so used to the dollar going down that they just figured that's what triggered the bull market. And it's like, well, not really. You can have a rising dollar in a bull market and a weak dollar. But the last 8 years, the dollar, in my opinion, has been on a rise. And you can see the impact on the relative strength of both energy and materials. So one of the things I've talked about is really avoiding these two areas until we see some sort of deterioration in the dollar. Do you have any thoughts on the dollar and whether or not do you consider this to still be in an uptrend? Or do you think we topped in 2017 and maybe starting a downtrend? Just wondering if you had any thoughts on the dollar.
Yes. You obviously don't read my messages, Tom.
Well, I do, but I'm setting up the questions for the audience, John.
I wrote a very interesting, I think it was interesting last week after the last Fed meeting when the chairman said that the fact that inflation was low, it was very, the downtrend in inflation was transitory. And I felt compelled to put up a chart of commodity prices, which have been plunging for 10 years.
Right.
If you want to, commodity prices are not the whole story, but they are an important indicator of inflation. If you want to figure out what's going on in inflation, a good place to start is look at commodity prices. They've been plunging over the last 10 years. That's not exactly transitory. And I also showed a chart of the dollar over that and showed that every time we've had an uptick in the dollar over the last 10 years, commodity prices have fallen. And as you point out, when commodity prices fall, that means that energy stocks, industrial metal stock, base metals, material stocks, even gold to a certain extent, generally underperform. And that is exactly what we've seen. So I tend to agree with you. As long as the dollar remains strong, there are better places to be than in stocks related to commodities. They're clearly in a downtrend. I wish the Fed would pay more attention to commodity prices when they're talking about inflation, because I remember reading that they say they're totally confused as to what's causing the inflation. All they have to do is look at a commodity chart. But I also made a point, Tom, and I don't want to get too much into the weeds with this, that why is the dollar so strong? Well, obviously the dollar is strong because we do have the strongest economy in the world. Also, we have the highest interest rates in the world. The Fed started tightening a few years ago. The rest of the world is still in Europe and Asia. Their yields are still negative. So we still have the highest interest rates in the world among developed markets. We still have the strongest economy. And as long as that's the case, I think the dollar will remain strong. And if that's the case, I think commodity stocks will continue to underperform.
Yeah, this is a chart. I don't know if you would recognize it, but based on one of your market messages a while back, it really inspired me to go back and take a look at the Treasury yield in the U.S. versus German's 10-year Treasury yield. And you can see that the bottom and this gets back to the point you were just making, the bottom in the U.S. Treasury yield minus Germany was back in 2011. And we have been on this steady move to the upside. And you can see the dollar, while it's not perfectly correlated, it certainly is impacted quite a bit, positively impacted to the upside with, as you said, Treasury yields moving higher in the U.S. versus Germany. And I always use German markets, whether it's the stock market or the bond market, because I find that the German market is the most positively correlated market with the U.S. In terms of both the stock market and the bond market. But I think this makes your point beautifully. And here's the correlation, which, if you're not a fan or you don't really understand the relationship here, I think if you draw this correlation and look at the difference in our yields in the U.S. versus Germany's, and then compare that to the direction of the dollar, you will see that we are positively correlated almost the entire time over the last 10 years. So do you have any other comments to add to this chart, John?
Only Tom, no, your chart is absolutely right. Our rates are low by historical standards. What's the 10-year? 2.5%?
Yeah, 2.5.
German yield is negative. I mean, so we're still a high yielding currency compared to them. But I also wanted to make the case that I think that I noticed that, we all follow the direction of the 10-year yield. It's very, very important. And it's been falling for the last several months. Part of that is because the Fed has stopped raising interest rates. But I think a mistake a lot of people make is they see our yields falling and they assume that's a sign of weakness in the American economy. And I don't think that's the case. We're falling because we're being held down by Europe. Everywhere else in the world, rates are negative. Like take Germany, for example. There's a very close correlation between the direction of German yields and our yield. Even though we outperformed, there was still a correlation. So the fact that the European yields are still negative and there's absolutely no sign of any of that changing, that acts as a weight on our Treasury yield. And it's very hard for our yield to go up when their yield is going down. So I think the fact that our yields are so weak is more a reflection of weakness in foreign markets than it is in the U.S. market. So I think it's wrong to misread that. Use that as I think it's wrong to use that right now as an indicator of U.S. weakness. I think that's misreading it.
Yeah. One other point here too. This is the 10-year Treasury yield. You were just talking about the move to the downside, and I can show you the Treasury yields in Germany, and there's the move down over the last couple of years. So it's been falling a little bit longer, and obviously, in my opinion, it's because our economy, I think the world views our economy much stronger than Germany right now and Europe in general. But a question that I have for you, and I was kind of perplexed for a while because I thought that the 10-year Treasury yield would bottom in December and we would just start to move back up. And with the yield moving up, of course, that means money is rotating away from the bond market. And of course, that money, if our economy is improving, that money should find its way into the S&P 500. But instead, what we've seen is the yield continue to drop. And I know the Treasury market was sending the Fed a message back at the end of last year, no more rate hikes. And the Fed kind of, went against that and said, oh, no, we're still raising. We still see positive, economy ahead, blah, blah, blah. And that was another factor, in my opinion, that caused the selling in the fourth quarter of last year. And I think the bond market is sending another message to the Fed right now, which is inflation's not a problem. Deflation might be the bigger problem. And I think that gets back to your point about commodity prices and the fact that dollar's been strengthening and commodity prices have been going down. I think the bond market is saying, Fed, you need to cut rates. What do you think about that argument?
I don't know about cutting rates, Tom. But first of all, the decline in those yields in the fourth quarter of last year, that was purely a rotation. When the stock market plunged, people did move into bonds and that pushed yields lower. But we all understood that. What was surprising, that you would have thought that when the stock market rallied so strongly this year, people would have sold bonds and pushed bond yields higher, and that didn't happen. And that was the surprise. I suspect that had to do with the fact that the Fed announced in January that they weren't going to raise rates; they were going on hold, and I think that stopped the upward trajectory in bond yields, and also the fact that so we had a very unusual situation this year where stock prices were rising along with bond prices. Mm-hmm. So it is a little unusual. It is a little unusual, but I agree with you when it comes to the Fed. I wish they would just look at a commodity chart. This isn't transitory. The fact that inflation remains low is normally a good thing for bonds, and it normally weighs on bond yields. So I think that is certainly part of the answer. And until we get a significant uptick in commodity prices, I don't think we're going to see any serious inflation pressures. And this is the first economic expansion that I've ever studied where we don't have inflation. Every late economic expansion that I've studied, as you know, I've written books on this since World War II. We've always gotten a burst of inflation. That's always caused the Fed to tighten, and that has ended every economic expansion in every bull market. This time we just don't have that. And no one totally understands why, and we're not quite sure what to do with it. You would think that the fact that the Fed doesn't have to raise rates should continue this economic expansion. But one thing that does haunt me is what happens if commodity prices really start to drop and we do tip into deflation. What are the central bankers going to do? They can't lower interest rates because they're already too low. What are they going to do in Europe when they're already zero interest rates? In Japan, they can't lower interest rates anymore, so they can't fight deflation. And that's something that worries me. And by the way, if we ever go into another recession, what are they going to do then?
Yeah,
the Fed interest rates are so low here. How are they going to lower interest rates to combat the next inflation, the next recession? And those are things that worry me.
Mm-hmm. All right. Well, if you're, we've talked a lot about the big picture and what's been going on. But if you were somebody sitting on the sidelines right now and you've been waiting on this pullback and we're now starting to get it, what would John Murphy's strategy be? I mean, would you be thinking about beginning to maybe jump in a little bit with this pullback, and if it keeps going down, continue to buy, or would you wait and try to find a discernible bottom in the market? How do you approach the market here?
Well, I think for those people who are who have missed a big part of that rally, I'm not sure I'd be jumping in right here, but I do think that it is time to start planning. Maybe if we go back and tested that 200-day moving average, something like that. But I do think, yes, I think that this will present a buying opportunity, whether it should start today or next week. Or the problem is if you wait for this thing to be resolved, it may be too late, because if they ever come out and announce that they solved the situation, the market will be up 5% the next day. So I do think that this dip, but maybe a little early, maybe a little too early, but I do think this dip over the next. I think the second quarter will be very volatile, and I think it will give those investors who missed out in the first quarter an opportunity to do some bargain hunting.
Yeah. All right. I did pull up a longer, 3-year chart here on the S&P 500, and you can see that since this buying began and we really started to take off back January and February, this is the first time we've actually gotten down even to test that 50-day moving average. And we have reversed quite a bit off the bottom from earlier. Now, the volatility, and that would be a whole different discussion that we could talk about for quite a while, John. But the volatility index, when it moves up and it gets up into the 20s, you look at the market 1 hour and it looks really bad. The next hour, it looks like you're reversing. And then 2 hours later, you're back at the lows. So it's really hard from an emotional perspective to try to figure out exactly what the market's going to do for the next couple of hours.
I think 20 to me, I know I think I read you use 18 as your threshold, but I always use 20. In other words, when you look back, anytime we've had a sustained move above 20, I don't know where, we were a little above it earlier today. I don't know where we are now, but if you get a sustained move, there you go, right on cue. We're sitting right on 20, which is just a little bit above it. If you get a sustained move above 20, say a weekly close, I like weekly charts. What day is today? Thursday. If we got a Friday close above 20, that would signal to me that we're going into a period of higher volatility, which doesn't mean a big correction. It just may mean that we're going to pull back a little bit, maybe even move sideways for a while. a period of consolidation would be preferable, obviously. But I think we're due for a period of volatility. I think it's a good thing, maybe not over the short run, because I think that against a lot of money, I think, sitting on the sideline waiting to get back into this market. And I think a little period of volatility here might be a good thing.
Yeah, and you know, I just kind of drew a couple lines on the chart. I drew one at 18, I drew another one at 20. And you can see, I mean, it's not going to turn right on a dime, but you know, we've had plenty of times where over the last 5 years, we have moved back up close to 18, maybe up to 20, maybe even a little bit above 20. Right. And I don't have the S&P 500 on this chart, but I could probably pretty much guarantee you that each time we've had these volatility spikes up into this area, with the exceptions of the big selling that we saw in 2015, 2016, and again, the selling we saw earlier in 2018, and then, of course, fourth quarter, those were a little bit more extensive, but many times we'll get a spike like this, right, and all of a sudden it just kind of subsides, the volatility goes back down, the market moves back to the upside. I suspect that that's probably what we're seeing now, but where exactly the market goes in the meantime is really hard to say.
I think it's probably a good time just to stand back and watch it, Tom. If it, you know, just to watch it a little bit here. I wouldn't get too aggressive. I'm sure some short-term traders are taking profits. I think it's just a good time to watch it for a little bit and you know, pick your spots a little bit and see how we can ride this. Hopefully, the charts will offer some kind of a guide as to you know, when this thing has run its course and work off some of this overbought condition. But I do think I kind of agree with you that I think that any pullback here, hopefully I would prefer a period of consolidation for a couple of months. Mm-hmm. Hopefully that will provide, I think it will provide some better buying opportunities.
Yeah, one final point on the VIX, if you're looking at the chart, a lot of times you will see on these weekly charts, you see a long tail to the upside, meaning intra-week, the VIX was much higher and then came back down and closed much lower. Most of these tops have that kind of a look to it. And right now, you know, we're coming off of the earlier high. I would just simply say if the next, you know, if by tomorrow at the close, the VIX is back down to about 16 or 17 and the market has taken back off again, that probably, in my opinion, is marking an important short to intermediate term low in the S&P 500. But we'll see. Never know for sure, right?
Tom, if I'm looking at that right, we're back below 20 again. Am I looking at that right?
Yeah, just barely. Yes.
So I've always found 20 to be a very useful number. Maybe it's just a psychological number, but you know, if we got a decisive close above that, especially on a Friday, I think that's what it would take to really give me a signal of more volatility. But 20 is the key level, and we're just testing that right now.
Got it. Well, I tell you, John, it has been a pleasure. We have waited way too long to get you on this show for a discussion like this. So will you please come back and join us soon?
I'll try to. And thank you. Thank you for doing the charts for me, Tom, and following along. And thank Erin. Thank you very much for contributing. And we all had a lot of fun.
Yeah, absolutely.
I wouldn't call it fun, but it was interesting.
It was actually a good week for you to come on because I know, you know, with all the nervousness in the market and the trade deal and all the foreign markets and the intermarket relationships, it was absolutely a perfect time to have you on. So I really appreciate you stopping by.
Thank you very much. It's a pleasure being here.
All right. There he goes.
Excellent.